Unseated investors extrapolate recent past performance into the future and forsake diversification, and then they take unnecessary risks. So they say, well, the market's going to keep going down, or it's going down, so it's going to keep going down. It's never going to recover. Or the market's going up, it's going to keep going up. We have to remember it can change at any time. This was a clip from the movie The Big Short. The Big Short is during the financial crisis when they had all those CDOs and stuff like that. They'll explain a little bit, but everybody thought during that time period, 2005, 2006, going into 2007, real estate was going up, right? Can never go down. Real estate can never go down, can it? Yeah. I had clients wanting to flip condos, highly leveraged, 10% down, 20% down. I can make a lot of money doing that. Okay, so this is investors extrapolating current performance into the future.
Well, here's Dr. Richard Thaler, father of behavioral economics, and Selena Gomez to explain.
Okay, so here's how a synthetic CDO works. Let's say I bet 10 million on a blackjack hand.
10 million because this hand is meant to represent a single mortgage bond. Okay, Selena has a pretty good hand here, showing 18, dealer showing 7. That's a really good hand for Selena. Good odds. In fact, her chances of winning this hand are 87%.
So, my odds are good. I'm on a winning streak. Everybody in this place wants to get in on the action. How could I lose, right?
Now, this is a classic error. In basketball, it's called the hot hand fallacy. A player makes a bunch of shots in a row. People are sure they're going to make the next one. People think whatever's happening now is going to continue to happen into the future. During the real estate boom, markets were going up and up, and people thought they would never go down.
So people who are watching and think that I won't lose will make a side bet. Now this is the first synthetic CDO.
I love Selena Gomez. I bet you 50 million she wins, and I'll give you a 3-to-1 odds.
3-to-1 odds? Okay, I'll take that bet.
Now, somebody else is going to want to make a bet on the outcome of their bet.
50 million she wins.
That will lead to synthetic CDO number 2.
Hey, I bet you 200 million that lady in the glasses wins that bet.
She probably will win, so I want a great payoff.
How about 20-to-1?
Deal.
And this will go on with more and more synthetic CDOs.
And we can transform an original $10 million investment into billions of dollars.
You okay?
No. I actually feel pretty sick.
The winning streak is gone. So you can't extrapolate current performance, whether good or bad. So when markets are going down, we can't extrapolate that into the future either. But this is what people saw in 2013. And then they forget about this. First 43 days of 2016 was down 8.77%. There were 3 months in 1987 where it was down 29% in 3 months. Now we know, looking back on hindsight, that it went back up rather quickly right after that in just a few months. But there was 1 year in 2008 and 2009 where it was down 43%. They forget what kind of risk is in 100% stocks, 100% large U.S. stocks. This is not diversified, even though it's 500 stocks. And then 3 years, from 2000 to 2003, minus 41% during that time period. 5 years, minus 29%, and then here's the shocker, if you are not diversified. There was a 10-year period from 1999 to 2009, that is, if you started in 1999 at the peak, you lost money in large U.S. companies.